Good day, guys. My name is CryptoKib, and today I want us to discuss about trading indicators. I know indicators are not new to you, and you must have even tried one or two of them before, but then it is still necessary for me to discuss about indicators because I make beginners lesson for now, and then as a beginner, there are things you should know about some indicators and how to use them. If you have already used or you currently use an indicator, you can still watch it as you may catch one or two things. So let's get it started. So what are trading indicators? Like I've said here, indicators are technical trading tools that tend to predict the direction in which price is going, and by so doing, it gives us a directional bias and guidance with a sense of security. We all know that indicators are technical analysis tools that we can use to analyze the market in order for us to know when to enter or when to exit. So, indicators are designed to give us a sense of security by assuring us that once an action occurs, a reaction is about to follow. In this case, if an indicator points to the upside, which is the action, then the reaction would be that price is about to and likely heading upwards. Indicators can be used as entry and exit signals. As well, indicators can be used to spot the current conditions of the market if it is favorable without the need of finding out what the structure of the market is. Indicators can also be used in both trending markets and sideways or ranging markets. There are many types of indicators, some of these indicators can be combined to give confluence by traders so as to avoid false signals from a single indicator use. You also want to beware about this last statement. As much as you can combine more than one indicator, like one or two or three, for confluences, you also do not want to over combine a lot of indicators to avoid what we call information overload. When you have information overload, it is getting a lot of information from separate and different sources. Some of the times, you will be biased towards one of all these indicators you have deployed on your chart. And getting biased to one, the one you have been biased to might actually be the one giving you a false signal. So you do not want information overload, as they calculate their signals differently, and what they use in calculating them is different. Sometimes they give you accurate confluence, whereas sometimes they do not give you accurate confluence. One may be saying buy, whereas the other one may be saying sell. So you want to be careful about combining a lot of indicators in the sense that you want confluence. Like I said here, indicators can be used as entry and exit signals. That is correct. Indicators will tell you when to buy into a market. They also tell you when to sell into a market. But as we know, most of these indicators are lagging. So sometimes the reaction they give you may be too late. Or let me say the action they give you may be too late, as price is already at the top before it gives you a buy, or price is at the bottom before it gives you an exit signals. So let's continue. Okay, one more thing before we continue. I said here that indicators can be used to spot the current conditions of the market if it is favorable without the need of finding out what the structure of the market is. That is correct. Like we have trend indicators, you can easily deploy them on your chart and see if the current market structure is bullish or the market structure is bearish without needing to calculate and look for higher highs and higher lows, or lower lows and lower highs. You can easily deploy the indicator and you will see if the market is bullish or if the market is bearish. So what are the categories of indicators? The categories of indicators, of trading indicators, can be divided into the following. We have trend indicators, we have momentum and strength indicators, we have volume indicators, we have levels indicators, and we have mean reversion indicators. You should know that different categories of indicators are classified as either leading or lagging, but overall, all indicators are lagging when compared to price action. What I mean here at the last statement is some are leading, as in some they give you good information ahead of time. It gives you the buy signal or the sell signal before smart money or before big buyers step into the market. So you have bought just before the price shoots to rise bullishly or rally very rapidly. Whereas some are lagging, as in the market might have already made its run, a rally or a dump before it's giving you the buy or sell signal. Let's get into this. You will catch up with some of these examples that I'll be showing in this lesson. So we have trend indicators. So trend indicators is used to analyze whether price is trending, as in moving up or down, rallying or dumping, or sideways over time. And by so doing, easily show you if a market is bullish, bearish, or ranging. An example of trend indicator is the moving averages. We have the simple moving average and the exponential moving averages, with the difference being that the exponential moving averages are more responsive because it has more weight to current data. Therefore, it can follow prices more closely. That has to do with the calculation or the way EMAs are calculated. They add more weight to recent data, as in current prices of the market. EMAs combine or MAs combine series of periods to calculate the average for that particular time which you are. So EMAs add more weight to the closest one, the recent ones, than the past ones. I hope you understand what I'm trying to say. So moving averages look back at price action over a specified period of time and subdivide the total to get the price value. The price average is updated for every new bar created by price, hence it's named the moving averages. This is what I just explained. Like you ask the moving average to look over a 50-day period, a 10-day period, a 5-day period. Day here means period, as in if you are trading on the daily chart, then day today will be a day, yesterday will be another day. So talking about 50-day here means 50 days back. Then you will calculate it to get the new average. Once you enter the next day, you have to get an average for that particular day, which means it shifts the 50 from the static point into the future by 1 day. So it's like it removes one from the previous one. If you're counting from 1 to 50, you have to start at one point and end there. Instead of extending to 51, it shifts the 50 into the new day. So the first past data is removed. So then it keeps running. It keeps running for every new day or every new bar of price created. So it is called moving averages. It moves with price. You can deploy multiple moving averages on your chart and give them different settings to evaluate different data, such as having the 50-day, 100-day, and 200-day moving averages, which are the most common. The day here refers to the period of price action at which the moving average will look back at. The 50-day or period will signify short term, while the 100-day will signify mid-term, and the 200 will signify long-term in this case. This is simply saying the moving average should look back at 50-day period or 50 candles back, and looking at 100 candles back and 200 candles back. The 200 is larger than the 100, while the 100 is larger than the 50. So it's only how do I say, it's only normal that the 50-day is the shortest term, while the 100 is a mid-term and the 200 is the long term in this case. You can customize your settings for these indicators to be specific to your needs. Like you can have them at 8, 13, and 21, or 21, 35, and 55, or any other number at all that you may personally want. You have to play around with these settings while looking at how prices react with those settings, so you can find the best settings that fit your style. Everybody has their own different styles of trading, so you want to get the settings that work with the way you want to trade, or the settings that work with the way you trade. You want it to be exactly to exactly give you a buy signal when you need it to, not when it is already late. There are many ways to trade using trend indicators, of one of which is the MA crossover, and the other which is our support and resistance. So let's quickly take a look into how to deploy the moving average on the chart. So let me go onto a bigger timer. Excuse my drawings. Okay, so if you want to deploy the moving average, assuming we have a chart here, right, and you want to deploy the moving average, you have to come to where you have indicators. They are above here. You just put your mouse over and then you will see indicators and strategies. You want to click that, then under the built-in, you can just search for any of the indicators you're looking for. So here we are looking for moving average. As I type moving, then it will give you display. So here we have the moving average, and then we have the moving average exponential, which is the EMA. So we can do any one, but let's do the EMA. Most people use the EMA. So here we have deployed the EMA. We have deployed the EMA. So if we click down, we can see the EMA here with the settings. We can see the EMA with this. If you click the settings here, you can change the number. It's default, the length to look back at is default at 9. We can change it to whatever we want. Like I said, most people deploy more than one of these MS. Some people also use one for trend indication. Like if you want to see what the market structure is without looking or without counting higher lows and higher highs, as you can see, price is above of this moving average, so it is assumed that price is currently trending higher. But once you see the price below it, like here, and it extends, it continues to stay below it, then you will assume that price is bearish, so it will be in a downtrending. Like I'm trying to find an example of, if I can get where the price is below it. Okay, like here, like we have here. So the moment you deploy your MA and see this, this shows that the market is in a downtrend. And as it is right now, it shows the market has switched to being in an uptrend. So we are currently in an uptrend according to the MA. So if you want to trade with the MA, you can use it as support and resistance. You can also use a crossover. So let's start with the crossover. With that one, we have to deploy a minimum of 2 moving averages. So I will go back to my indicators tab and add more moving averages to the chart. So I will add another exponential to make it 3. But you want minimum of 2. So I want to go over to the settings of each and change the settings because they are all at default settings. So I will change this particular one to 50. Click OK. Leave the source as close. That means close of the candle. You can choose open, high, low, close, high, low divided by 2, high, low, close divided by 3, open, high, low, close by 4, and continuous. But most people use the close. So here I have the 50 day, here we have the 100. And the last one, I will put the 200. Most people use this with a simple moving average. As you can see, this yellow one is a 50. This is a blue or kind of blue is the 100, and the third one is the 200 day. Now, looking at this EMAs alone, we can see that this price is currently in an uptrend. So what are you looking for? You are looking for buy signals, right? But then at this moment, the price, the crossover has already happened. When we are talking about the crossover strategy, it has already happened. Looking at all these price action, it has already happened. So I'm trying to look back and see where the cross did happen. So we have one here. So what do? When you see the yellow cross over the, I don't really know this color. Let me just change it. You can change colors here. Let me change it to red, kind of. Okay. So when you see the yellow one, which is a 50-day, cross over the red one, which is a 100-day, and then both crosses over the blue one, which is a 200-day, you know that is a strong buy signal. That means the short term is on the midterm and the midterm is on the long term. And for price to be on top of these three moving averages, including the long term, means price is about to go bullish for a long time. So the moment you see the crossover happen, like it happened around there, what are you looking for? You are looking to buy. So assuming it happened here, assuming you have bought here, we had a little retracement, like a pullback to the MA, and it found support. This is one way of using it as support and resistance. Then what happened? Price rallied up. And I'm trying to calculate the percentage of price, 20%. But then if you had bought here, for you to say you want to see it cross down again, and going back, we can see the cross down here. We see a cross down here. There, the yellow crossed the red, and then crossed the blue. Then here, the red crossed the blue, which means and price were under. But this cross didn't quite happen almost at the same point like it did here when it was going upwards. So here you have to apply some caution because you do have a lot of fake outs. So going back, you can see here too, it's not that perfect, but it was okay. At the moment the three crossed upwards, and here we can see the full cross is happening here. We had the move, the moment it crossed, we have a move and a pullback so close to it, and then a big rally. So assuming you bought here and then you are looking for a sell. Now let's see what happened. We do not get a cross under yet, and we have a very bullish move up to this extent. So let's try and mark the moment it crossed, so we can calculate the percentage it has yielded from the moment it crossed. We had a cross around there. So assuming you bought that very moment it crossed up. Wow, I can see it clearly. Okay, assuming you bought somewhere around there and that price has come even way above here, which is like 150% already at this 70 something point, and then which is here, and then from here we had another 130%, which means this coin has done more than 300% from the moment you would have bought it here. And you will still be in this trade if you were to be waiting for this MS to cross under before you sell. The problem is sometimes they will cross under, but then it will be late. You will have given back to the market a lot of money. You will put a lot of money on the table. So let's look at the second way at which you can trade with the moving averages without using the crossovers, and that is the support and resistance. As you can see here, the moment it crossed, we had the price rally. We have price coming back into the 50-day moving average. It found support here, right? It tried to go up, find another support, but then it broke the 50-day moving average only to find support at the 100-day moving average, which is a midterm. Then we had price come back up. Then it wasn't done. It came back again, broke the 50, the 100, and it found the final support at the 200-day moving average. And what happened the moment it found support at the 200-day moving average? We have a rally to the upside, as you can see, a very big rally. So assuming you have your order waiting at this very MA up to this point, you have like 40% profits. And then what happened after this? We saw price coming back into the 50-day again, trying to get support but failed. Comes to the 100, tried to get support and failed. Then it came down to the 200, and what did it get? It found the support it needed, and then you can see price coming back up again. So these MAs are acting as support and resistance. The 50-day might support price for a very, because it is a short-term move, right? It is short-term compared to this, so it might give you a little profit. This one might give you a okay profit, while this one, the 200 day, will give you the larger profit. Looking into the future again, we saw the 100-day performing the support here, right, where price move broke the 50-day, found support at the 100-day, and price rallied. But before then, we saw the 100-day, I mean the 50-day here at this point, giving price support and then rallied to the upside. Then when price returned to it at this point, the 50 couldn't hold, the 100 couldn't hold, but then the 200 held. And what happened is this, all this massive run. And then since then, we haven't had a retest of this trend line, I mean of these moving averages. So what will you expect the moment price is coming down, like we see price is coming down? You will believe that price may come down from where it is into either the 50-day or the 100, but definitely you expect it to come into the 200 and then find a larger support, which it will need to put price to new highs. So that is how you can use moving averages. Let's go to a lower time frame and see if we can get where we have the cross under. Okay, as you can see, we have the crossover here, not perfect as all didn't occur at the same time, but it still worked the way we wanted it to. And here we see price MA is giving price support. Here we have it failed, but here we saw the 200-day. The moment it closed under, we saw it giving it resistance. It resisted price from going up like 2 or 3 times, and then we are back above it now. Now if you notice at this point, the yellow now, which is a 50-day, is trying to cross above the mid-term moving average, which is the 100-day. At the moment it crosses up, what do you expect? The price is still above the 200-day, right? Which means price at this moment is bullish. So but the moment the yellow line crosses the red line, we expect price to continue the rally. Nonetheless, we might have a retest of this, either of these trend lines, either of these moving averages, and then find support to continue to the upside. So that is how you can use moving averages. I'm still trying to get a cross under. Okay, here we have the cross under, and here again we have what you call the sideways. So when you deploy your moving averages and you see it like they are together like conjunct twins, they are together, they are not either above price or below price, but they are interwoven with price itself. That means the market is in a sideways action. You cannot use moving averages to trade in a ranging market. It is not possible. It will only give you whipsaw and false signals. It can cross up like it did here, but price didn't go up, but then it came back to cross under here. At the moment it crossed under and price was clearly below it, price came up but couldn't go above it, couldn't quite touch it as well, only to drop down. That shows that the market is no longer ranging but downtrending. And what do we have here? We have it playing as resistance. The 50-day couldn't hold as resistance, but the 100-day did hold as resistance. Sorry about the alert. So we see price coming all the way down here. So if you cannot buy the moment it all crosses and you have a clear cross like this to the downside, if you cannot sell at this point, then you should wait for it to retest the moving averages before you sell or you go short. And the moment you do, you expect price to rally back down. And here, what do we see here? We see the 50-day giving the market resistance. It acted as resistance here, pushing price back down. It came back to it again and acted as resistance, but not for a long time, only for price to break above now, trying to find support. And the moment it's interwoven with price, you do not want to trade. Here again, as you can see, the yellow cross above the red, which is bullish movement, but couldn't quite cross above the blue line, which could have given you a even longer time bullish movement, only to then cross below, back below, and then we have a bearish continuation to find support somewhere else, and then later on it crossed back above. Now this is why they say the indicators are lacking. Look at this price action from these very highs to these very lows. What do you think happened from this point here to this point? This indicator is not trending because it is a trend indicator. It shows you trend, and especially when you trade with the trend. So either the market is in an up move or the market is in a down move. But at this particular point, the market was clearly in a down move. The indicators wasn't giving you any clear signals. It came above this red one here, then only to come below it again here at this particular point. And how is it lagging? The indicator finally crossed completely at this point here. The yellow crossed the red at this point, then crossed the blue at this point, while the red crossed the blue at this point, and you want the three to cross before you buy. That means if you want to buy any action at all on this market, you will be buying somewhere around there after it has completely crossed. So how is it lagging? Here we saw price coming down to this point we have boxed. So why can't you buy at this particular lows? If you have bought at this particular lows, you might have been a profit of how much? 17% before you can even buy. A lot of profits which you have left on the market, you didn't even partake in it. You didn't take this profit because you were waiting for a confirmatory signal. And at this point where the market is crossing, you can't tell if that is the top you are buying, because it happens most times. Whereas after the MA crosses, you will only get it crossing back below, like it happened there. We have a cross above here, only to, especially when you use 2 MAs. If you are not using the blue one, assuming you are using just 2, you have it crossing above here, which gives you a buy signal, right? The moment you see it is fully crossed at this point, assuming you bought at this point here, this green candle here, or even here, you don't have a lot of profit, only for you to see price coming back and the MAs crossing back under, giving you no profit at all but losses. Are you trying to get why they say indicators are lagging? The signal that even came at this point, if you had to use 2 MAs, the signal for buy came at this point when it crossed over. And if we look at this point extremely, let me take a vertical line. If we look at this point where it crosses exactly, it is on top of this green candle. If you are bottom close of this green candle, look at the percentage from this top to this very top, it got to just 2%, only for it to come down. I don't know where you might have your stop, but if you have your stop below here, you won't be out now, but sometimes you will be taken out. Whereas you could have bought at this particular lows here, even before the MA showed you any signal. You will be making a lot of profit before then. And if we continue to look, now see here, we have a cross under here, right? Which means the moment you have this cross under, you want to sell. And what is that moment did this cross? It was around here to here. So here it became clear that the market has crossed, which is this red candle here. Assuming you have sold at this close of this red candle here, then you'll be in a profit of 0.93%, only for price to then come back up. And what are you trying to get here? We are trying to get it close above here. We are trying to get it cross above here from this MA. Now it's interwoven with price, which means it's not clear. It's either it's coming to find support at this point, or it's close on down and find resistance. So sometimes the indicators gives you false signals. Let's end the moving average videos here, and then I will continue the next slide in another video. Thank you for being with us.